direct indexing says, instead of owning an ETF, we're going to own what's called a separately managed account, okay? The separately managed account, instead of owning ETF mutual funds, owns a number of individual stocks whose intention it is to perform like the ETF, like the benchmark, right? So if I own SPY, I'm going to get the performance of the S&P 500, right? If I own a direct indexing account that is, we call it benchmarked to the S&P 500, the objective is that account will have what's called a tracking error to try to, its objective it is to closely track the index that it follows, okay? But conceptually, what happens is we now own an individual stock account, which allows the manager of that portfolio to systematically tax loss harvest. There are all different types out there, but they are using technology to be able to deliver superior results to those that we can deliver on our own by manually tax loss harvesting. But especially in very volatile years, where there are a lot of harvesting opportunities, we've seen occasions where the S&P 500 was up 18% in a year, but one of these types of portfolios actually delivered you 18% return, but also harvested 17% of the account value in losses. That means you take your $1 million of idle cash at the beginning of the year that you have sitting somewhere for a rainy day. You instead invest in a portfolio like this. At the end of this year, in the example that I used, you now have $1,180,000, but you also are holding a $170,000 paper loss that you can either bucket, use for a future liquidity event. You can use against your real estate sale that you might have one day. So very, very powerful strategy